I think what we're going to see, Alan, is a redistribution of that asset allocation within those underlying kind of portfolios. Because if you structure your portfolio on the basis that CTAs have pretty much no long-term positive drift, but are just there for crisis alpha, you're going to structure your portfolio one way. If you actually look at it on the basis of, well, hold on a second, actually they have significant positive long-term drift, significant positive Sharpe, and they provide crisis alpha, you're going to build your CRO or RMS portfolio in a different way. So that's where I think the allocation will come from.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kostrup Larsen.
Hey everyone, and welcome to another edition of our Top Traders Unplugged series, where today Alan Dunn and I are joined by Anthony Todd, co-founder and CEO of Aspect Capital, as part of our conversations with industry leaders in the world of managed futures, and with a bit of a bias, of course, towards trend following. First off, Anthony, it's great to have you on the podcast. Thanks ever so much for joining us today. We have really been looking forward to our conversation. So I hope you're all set for Easter in your household.
Yeah, it's terrific to be here. It's going to be, I think, pretty quiet Easter in the Todd household. My daughter has got chemistry finals actually kind of coming up in a few weeks' time, so she's going to be working away. My son's got exams coming up, so he's going to be revising. So it's going to be a very, very low-key, quiet Easter for us, but thank you.
Sounds good. Now, before we dive into all the different topics that we're going to discuss, I would like to set the stage for our conversation so that the audience knows a bit about your background, as we normally have your research director, Martin Luik, on the podcast, of course. So perhaps you could share just a few highlights from your journey that ultimately led you to running Aspect Capital today.
Yeah, happily. That's said, wonderful to be here. In terms of my background, I wish I could say that it was all carefully planned in advance. It wasn't at all. It was all just a series of happy coincidences. The first coincidence, actually, Martin and I go back a very long way. I read physics up at Oxford, and there was fortunate enough to meet up with Marty. He was also reading kind of physics there, and Michael Adam, so obviously the A and L of AHL. I then went straight from physics, joined a broking firm called Phillips & Drew, later taken over kind of by UBS, worked in the government bond desk there for a number of years. Actually joined there, remarkably, at the start, the very start of pretty much a 40-year bull market. So when I started actually working at Phillips & Drew, I remember 10-year yields there were around the 14-15% level. So it was a remarkable time to be working in the fixed income markets. I think what struck me, and one of the great draws for me into systematic investment management, into the CTA sector, was sitting on the trading desk at Phillips & Drew, surrounded by a whole raft of different traders. And I could see that there was a common trait amongst all the successful traders. And that was the application of a highly disciplined approach. Not necessarily, I wouldn't call it systematic, but a very disciplined approach and a relentless focus on risk management. That approach always kind of fascinated me. And of course, meanwhile, stage left, there were Mike and Marty, and then joined obviously by David Harding in 1987, building a highly successful, completely automated systematic investment management business. I left Phillips & Drew in the late 80s, went to business school, went to INSEAD, brief spell in consulting like everybody else who did an MBA at the time, and then was approached by Mike, David and Marty to actually join AHL. It was just too good an opportunity to turn up. At that stage, AHL had about 200 million under management, a team of about 20 people, and was just beginning to go through a significant period of growth. So I was very lucky enough to actually join them in 1992, at an early stage of that kind of growth spurt. Stayed there until 1997, had a fascinating kind of time there over that 5-year period, and then spun off in 1997 with Marty and with Eugene Lambert, who'd been head of trading system development at AHL and founded Aspect. So that's the short history.
That is the short history, and it's a fascinating story. And of course, I did have the pleasure that people should go back and listen to interview the founders of AHL together a few years back when they had their 30th anniversary, I think it was. So it must have been around 2017 or something like that. Anyways, yes. That's not for today. Today, it's all about you and an Aspect. Now, Alan and I have created a list of topics that we're going to talk about. Things that we find interesting, things that often come up in conversation, and of course, something that is inspired of some of your latest research. And I hope we've found a way to structure it in a logical order. But before I hand it over to Alan, I thought it would be great to hear a couple of big picture or touch on a couple of big picture topics. The first one being not really related to our industry, but really kind of where you see the world today, kind of a big global macro overview framework, because I think that will set the stage for some of the topics we will discuss later on, if you don't mind.
Yes, I mean, I think, in terms of, macro environment, I mean, the first thing I always say, Niels, is in answer to kind of questions like this, have to kind of bear in mind we have, we're not economists, at all. Everything we do is entirely kind of systematic. So I think if you ask anybody in the business, anybody in the company, we're all going to have a view about what's actually happening in terms of the global economy. That has no bearing, on our models, on our research, on the positions we're taking at the moment. But I think, looking at the world at the moment, I mean, I think what's actually particularly kind of striking is that we've just seen this complete seismic shift in the market environment. So if you look at the kind of period, post the kind of GFC, we saw an extended period of coordinated central bank intervention, QE on a global basis, zero interest rate kind of policy. Significant levels of government intervention. And it was that significant government intervention in the markets, central bank intervention in the markets, which distorted market price behavior and limited the ability for markets to trend effectively across multiple fronts. And I think if you look at it now, I mean, of course, at the time when the CTA sector was going through quite a challenging environment, there were lots of kind of hypotheses as to why that might be the case. Had the sector become overcrowded? We can talk about that a little bit later. Had markets just changed? Was kind of trend following just not fit for purpose any longer? We always very much took the view, and I think it is one of the advantages of having worked in the sector for 30 years, or in Martin's case, actually pretty much 40 years, that we could actually look at these hypotheses about market behavior, examine those kind of hypotheses, and very much reach the conclusion that actually this time wasn't different. Market behavior hadn't actually changed. Markets, the sector had not become overcrowded. And actually the right thing to do was to retain a consistent approach, not speed up, not slow down, not change the sector allocation, but just maintain that kind of style consistency. What we've actually seen now, of course, in terms of that shift in the market environment I can talk about, we're now in an environment where we're actually seeing that level of coordination has very much gone out of the window. You can see last week, by example, the Bank of Japan actually raising rates for the first time in 17 years. You see, on the other hand, the Swiss National Bank, first G10 economy to be cutting rates. So suddenly that level of coordination has actually gone out of the window. We're moving from a QE environment to a QT environment. We're moving to a more inflationary environment than we saw certainly 10 years ago, renormalization of interest rates, and that's creating a wealth of opportunities across multiple fronts. So now, in terms of big picture where we sit, very exciting time again to be in the CTA sector. Our business development team at its busiest we've actually seen for 5 years. We could talk about some of the trends we're actually seeing with investors in a moment.
Yeah, no, absolutely. This was great. And I think you touched on a lot of important points that would be relevant for our conversations. The other big picture topic that I wanted to maybe set the stage with is, now we've talked sort of global macro, even though, as you say, we don't use it in our models, but The other thing that would be interesting to hear your perspective on is really big picture, sort of state of the union of our industry, the managed futures / CTA industry. And in your perspective, in your experience, what you feel has changed and maybe what you feel has stayed the same over that 30-year period.
Yeah, I mean, I think, the big change we've actually seen is, looking over a 30-year kind of period, I think that the major change we've actually seen is just a greater level of understanding, of the CTA, sector itself and the drives of returns. So again, if I'm looking back, over a kind of 30-year period, there's no doubt 30 years ago, there was a high degree of skepticism as to whether really a systematic, rules-based, disciplined, trend-following approach could generate persistent returns in the markets. I think that battle has now been kind of firmly won. And again, if I look back at the origins of Aspect, actually come back in 1997, back at that stage, we were beginning to see, at AHL, just gradually emerging interest from institutions in the sector. But it was it was pretty much front page news. If a pension fund actually invested in the sector, it would be a major breakthrough. But the point was that the majority of managers at that stage were ill-equipped to be able to meet the requirements of institutional investors. So if you look at managed futures back 30 years ago, fees were absolutely sky high. Level of transparency was minimal. It was regularly referred to as a black box strategy. Volatility was extremely high. The products were typically packaged up in a guaranteed, principal protected format, sometimes with entry fees, often with exit fees. So institutions under the covers could actually see here was a valuable source of diversification, valuable source of returns uncorrelated with stocks and bonds. But in that format, which I've just described, was completely unpalatable for institutional investors. That was very much the catalyst behind actually founding Aspect Capital. What we wanted to do is build a business that would actually meet the requirements of institutional investors. So that meant actually building a business with a heavy emphasis on research and development. So research-led focus as opposed to a sales-led focus, providing a high level of transparency. And in addition, absolutely making sure that we could provide a managed account, flexible managed account platform to enable investors to customize solutions. So that, to me, looking and answer your question over a 30-year period, that's been the biggest shift we've actually seen. If you actually look today in terms of the sector, the level of institutional investment, we actually see the level of awareness, the level of understanding, it's night and day compared with what we saw 30 years ago.
Yeah, no, I completely agree. It's such an important point, and how the industry has changed over the years, for good and for bad. I think you mentioned a lot of really good, important things, but I think also, of course, now that we have to cater much more to institutions, there's always a risk that we lose some of the origins that actually were also pretty special to our industry. But that's for another day. Alan, sorry to have you waiting for so long to jump in with your first topics, but where are we going to go?
Well, Anthony touched on the investor landscape and how that has shifted and is shifting over time. So curious to hear your thoughts on that. But also, you do talk about how, night and day versus 30 years ago. But one thing that myself and Niels often talk about, and we're talking about recently, is, despite the very strong evidence around, the benefits of trend following and managed futures, there still is a subset of investors who remain probably under-allocated relative to how much you would expect to see in a portfolio. How do you see that challenge, or do you still see that as being a significant challenge in terms of getting people to invest as much as you might think should be the right amount to invest?
Yeah, come 2 points there. I think in terms of the investor landscape, trends we're actually seeing at the moment, it is an really interesting time. I think one of the strongest trends we've actually seen, over the course of the last 7 or 8 years, actually has been investors focused on private markets, illiquid private markets, actually rather than liquid alternatives. So conversation after conversation after conversation with potential investors over the course of the last few years, I think investors have absolutely understood that it's so important to actually build a more diversified portfolio, but they've achieved that through investing in infrastructure, in real estate, in private equity, and most recently, this headlong rush into private credit. Now, I think in terms of trends, we're actually seeing increasingly talking to institutions and to consultants, we're finding that investors are bumping up against their ceilings in terms of allocation to illiquid assets and are beginning to turn their attention towards liquid alternatives. So I think the tide is beginning to actually turn there. In terms of demand that we're seeing, I would say the greatest demand we're actually seeing at the moment is actually from private wealth managers, who typically tend to be, if you like, first movers, tend to actually be highly agile in terms of their approach. The institutions, as they begin to shift their focus from illiquid alternatives to liquid alternatives, again, beginning to see strong pockets of demand actually coming through on a global basis. But to me, it's strong echoes actually of what we saw post the GFC in 2008. Of course, 2008, very strong returns to the managed futures sector, and against the backdrop of collapsing stock markets. I think there was just a general expectation that we'd see strong inflows in 2009, 2010. Actually, it took until late 2010 and actually really 2011, 2012 before the strong flows really came into the sector. And I think that's the lag effect we're actually seeing again now, that a lot of institutions are conducting asset liability studies. They're consulting their consultants, looking for advice as to how to navigate this completely new economic and market environment. So it is taking time, but the signs that we're seeing, talking to investors, talking to consultants, is the tide is firmly moving in the direction of liquid alternatives.
Interesting. And I know you've had a paper out recently around the role of trend following and maybe highlighting the more pro-risk characteristics of trend following at times. And obviously we're seeing that in the markets this year very much, very strong start to the year for trend following in an environment of positive equity market returns. So, I mean, historically, a lot of the sale or the positioning of trend following, at least for a period, it was around crisis alpha and the diversifying characteristics. Do you think that perception is shifting to that it can be seen as a return enhancer as much as a diversifier in portfolios?
Well, Alan, it's a really interesting point. I think what we're actually seeing here is a return to actually how managed futures, how the CTA sector was positioned 10, 20, 30 years ago. So if we just look at the market environment that we've been in over the course of the last 10 years, as I mentioned earlier, due to government intervention, central bank intervention, distorting market behavior, we had a challenging market environment for the CTA sector, really from 2009 through to 2018. And, in that difficult market environment, the one key argument that managed futures could rely on, could heavily depend on, was the ability for CTAs to actually provide that crisis alpha. So I think in an environment where there was only marginal positive drift in long-term performance of the whole sector, actually focusing on the long-term benefits in terms of crisis alpha, I think that actually absolutely made perfect sense. But I think actually the more closely we actually look at it, we've reached the conclusion that we have to look at it on the basis that the last 10 years, or that 10-year period, 2009 through to 2018, that was the abnormal period. And actually now, in terms of what we're seeing in terms of removal of that government intervention, we're seeing much more of a return to normal market conditions and a return to more normal performance from the CTA sector. CTA sector, when I started working in it 30 years ago, the positioning was very much, here's a strategy which is agnostic in terms of market direction, highly diversified, and has the ability of providing uncorrelated returns. The early arguments were not about crisis alpha. It was all about portfolio diversification. And I think that's what we're returning to now, given the market environment we're seeing at the moment, with a wealth of opportunities across multiple markets. and strong positive returns actually since 2020, it's much more returned to that original positioning that here's a strategy which absolutely does provide that crisis alpha. So let's not forget about the returns generated by the CTA sector during the technology bubble collapsing 2000-2003, the GFC income 2008, the collapse in stocks and bond markets during that inflationary environment in 2022. So it absolutely has that very, very valuable kind of crisis alpha set of kind of characteristics. But in addition, over the long term, has significant positive drift and has the ability to be able to provide strong returns over the long term, uncorrelated with stocks and bonds.
One of the things that I certainly have been also talking about for the last couple of years, and something that to me actually kind of became more evident once we starting having talks on a more sort of global macro level. And I remember we spoke with Peter Zion, and he talked about this sort of the Bretton Woods agreement, how the New World Order sort of developed for 70 years, and how globalization was coming to an end. Very much so with, as you said, around the 2019, 2020 level. But in your paper, you cite something that is very interesting and very visually that describes that in a different way. And that's the correlation between stocks and bonds. And I'd love for you to talk a little bit about that, because I sense, and I obviously agree with your points, but I sense that this has not really registered with institutional investors yet. So I'd love for you to share some of your insights on this.
Yeah, I mean, I think the good point there, and I think the chart that you refer to is one we're actually kind of looking on at the performance of global bonds during extended equity drawdowns, and we can actually see that historically, actually, the fixed income markets were able to provide that crisis alpha, if you like. That during the period 2000, 2003, the technology bubble collapsing. During the GFC 2008, once again, fixed income markets were able to actually provide that strong counterbalancing return. You had that flight into kind of quality, but the performance in 2022 actually kind of demonstrates that that's not something that investors can 100% rely on. So in an environment, actually a more inflationary type environment, a more inflationary type shock, can actually create a correlated meltdown in both stocks and bonds simultaneously. And I think that's actually what's really catalyzed a lot of institutional investors, a lot of private wealth managers to actually look at their portfolio construction and question, well, if we were to see a similar collapse again, we need other sources of diversifying returns. And of course, managed futures historically has been able to provide those very strong counterbalancing returns during extended equity market drawdowns.
Absolutely, and I'm going to link in the show notes to your website where people can find the paper. But also, I think in addition to what you explained, I think what people may be surprised is that even if you went back 125 years, what you'll know is that actually it's the norm that stocks and bonds are positively correlated. I think people have been conditioned to believe that that's not necessarily the case because we had this strong negative correlated period for the first two decades of this century. And also,
I think actually, Niels,
I
think actually on that point, I mean, I always find it fascinating if you look at the growth of the CTA sector. As I'm sure many of listeners to your podcast will be aware, one can trace back the history of the CTA sector right the way back to Richard Donchian launching the first managed futures fund in 1949. But the sector really took off during the 1970s. And you look back at that period in the 1970s, once again, Niels, that was another really strong example of an inflationary environment, two energy market crises, collapsing stock markets and collapsing bond markets simultaneously. And again, it was that type of environment with strong trends, negative trends in stocks and bonds, positive trends in oil markets, providing again a very rich environment for an agnostic, rules-based, trend-following type approach. So if you look at a number of CTAs around today, they can actually trace their origins actually back to the 1970s. And of course, if you look at the work that Mike Adam and Marty Lewick, they were doing back in the early 1980s, that was very much building on the work that Michael Adams' father had done, building systematic trend following models during the 1970s.
Yeah, no, indeed. And I do like the fact that you introduce, instead of crisis alpha, you introduce this unpredictable alpha, because I think certainly everybody is aware that we live in very uncertain times, and it's very hard to predict anything, of course, but it's even harder today than it was a few years ago. So I like that term.
Thank you. I didn't come up with it, but I will pass.
You'll take the credit, I'm sure. Okay.
I'll pass on the thanks to the team.
Sure. Now, we talked earlier about what had changed since we began in this industry. And there's one thing I can think of as well. And that is that back when you started, I started, and many of our peers started, firms were really single strategy type firms. And only in the last, I don't know exactly when, maybe 15 years or so, give and take, we've seen some CTAs, including yourself, starting to branch out and to become sort of multi-strategy firms, not to be mistaken by the multi-strat firms that we see today. So I'd love to hear your sort of thoughts about why you decided to go in that direction, and what drives this expansion of strategy, and how that might help serve your clients.
Thank you. No, I mean, you're absolutely right. I mean, we were, very much single channels, single kind of product focused business up until 2014, and then start a whole kind of process of actually kind of building out a much more kind of diversified kind of range of models. Some of that we did organically. Some of it we did actually through acquisition of either kind of companies or other teams. So if you look at Aspect today, we have a range of different models and programs spanning, of course, medium-term kind of trend following, but also encompassing machine learning, volatility-based strategies using options, alternative markets, kind of Chinese kind of markets, short-term models, RV kind of macro as well. Now, what was the thinking behind that, and answer your kind of question, Niels, was that what we were finding increasingly, during that period, the build up to 2014, during the period of 2011, 12, 13, that in our discussions with our investors, what increasingly they were looking to do is to narrow down, shrink the number of manager relationships that they were managing, but deepen those relationships. That the whole ongoing due diligence process was becoming just more and more complex. I think as strategies became more complex, and therefore it made absolutely perfect sense to actually look to deepen those relationships. But as I said, actually narrow down the number of relationships. So we were just finding, actually walking into client meetings, that we didn't have the ability to be able to have any kind of conversations beyond trend following. If an investor was actually interested in exploring, other strategies, maybe short term, maybe kind of RV, maybe equity based, maybe vol based, we were ill equipped to be able to engage those discussions. So that was very much the kind of catalyst behind actually building out, as I said, that kind of broader range of models. And what that enabled us to do is actually two things. I mean, first of all, those programs are available to investors individually. So we have client assets actually in each individual kind of program. But I think most importantly, what it's been able to enable us to do is to build customized solutions, build kind of tailored kind of portfolios for investors. So if investors actually kind of want, a particular combination of models, a particular kind of combination of underlying kind of strategies, specifically to meet particular investment requirements, we're now in a strong position to be able to build those customized kind of programs. So if you actually look at our total assets under management now, something around close to 30% of our total AUM is now in customized solutions. So it's very much that thinking that every institution is different. Every institution's portfolio construction is going to be different. Every institution's requirements are going to become different. And as you know, Niels, we've had a long history of forging very kind of close long-term relationships, long-term partnerships there with investors. And key to being able to do that is to actually be able to kind of build these kind of customized, kind of tailored solutions to meet specific requirements.
I'm curious about one thing, and what you say makes total sense. But I have one question that since I've never, been in a situation where I've been able to offer these kind of solutions, I don't know the answer to it. But how well equipped do you think clients are, external investors really are, to judge or to have a strong opinion about, an informed opinion about how to mix and match these type of solutions or opportunities? Because if I look at just trend following, a lot of people wouldn't necessarily say, yeah, I definitely need trend following by themselves. I don't know how well equipped investors are to see all the insights that we actually offer in these programs. So how do you balance the giving them all this choice, but also guiding them, because you obviously have a lot more knowledge about what goes on inside?
Yeah, Niels, it's a very, very good question, and I think that you're absolutely right. There's obviously there is a risk. There would be a risk of almost just kind of flooding an investor or consultant with a whole range of different models. So at the moment, as a business, we're now running over 200 different individual models. Now, as I said, spanning kind of trend following, short term, RV, vol based, equity kind of based. Now, actually, walking into a client meeting saying, almost we can customize anything. Here are 200 models. You tell us, what you need. That's an absolute recipe for disaster. That's a recipe to the end of the kind of conversation. So that there's no doubt in terms of discussions within investors. Some investors will actually be looking to us to actually provide the very kind of best program that we can actually provide in a particular sector. So if an investor actually comes to us and says, look, actually I appreciate you run all these kind of various different models, but what is your strongest model, your strongest program in the kind of trend following sector? We'd say, okay, it's the Aspect Diversified program. That's the program which has a 25-year track record. Now, there will be other investors we can talk to who will say, well, look, actually, in terms of the trend following approach, I understand trend following, but what I'm looking for is a couple of other components. One, I might be actually looking for a first responder, type of utility function, which we can actually provide with our option capability. They might actually also be looking for some combination of other strategies which are over the long term expected to actually improve the Sharpe ratio of that underlying trend following carrier wave. And on that basis, we could actually combine our trend following strategy potentially with a range of other RV type strategies. They combine, for instance, with our alternative markets program. So in terms of the conversation with our investors, as I said, some investors will just simply be coming to us and actually just looking for the strongest program we have, in a particular field. Others, there will be much more engagement about how can we actually combine, different programs. It's typically at the program level, not at the model level. It'd be rare to actually go down to those 200 different models and start picking and choosing from those. The conversation in terms of customization happens much more at the higher level, at the individual program level.
Yeah, no, man, makes perfect sense. So clearly that's one thing that we've seen change in our industry, the fact that we have now a number of firms, including Aspect, that offers a wide range of systematic trading strategies. The other thing that we've seen in more recent years, but not necessarily offered by CTA firms per se, more people who want to be part of our industry, but does not want to develop the underlying models themselves. So they're starting just to replicate returns, mostly done by looking at historical performance numbers and then do some kind of regression of this to come up with their positioning. How threatened should we be as managers, do you think, by replication strategies? And how do you view them in general? Are they good for our industry? Are they a threat, as I mentioned? And maybe are there any risks that you see with these strategies that people should be aware of?
Yeah, I think first of all, say that do they actually represent a threat? They are gathering assets, at the moment. So let's go de facto. Yes, they do represent a threat. Obviously, the kind of key challenge, I think for the underlying managers is we have to kind of demonstrate our ability to actually outperform those kind of replicators over the long term. And I'd be very, very confident that we're in a strong position to be able to kind of do so. In terms of the concerns, you asked about the risks. I'd highlight 3 risks, Niels. The overriding, I'll break it down into the kind of 3 individual kind of sub-risks, but our overriding concern is that the replicated funds don't reflect the finer details of the underlying kind of CTA kind of strategies. And as I said, that to me actually is potentially going to lead to significant underperformance over the long term. To me, the investors actually need to kind of focus on three key questions. First of all, the replicator kind of strategies, but in terms of how they are built, there's an inherent position lag in their responsiveness. So kind of question number 1 is, how are these replicator kind of funds actually going to kind of perform during very kind of sharp market corrections? Kind of question as to, are they going to be able to kind of perform competitively in that very tough market environment, and exactly the kind of market environment where investors are actually kind of looking for those diversifying returns? The other element is that of the replicator funds, we've looked at, they tend to actually kind of try to replicate the performance using a relatively narrow set of markets. So if you actually kind of look today, for instance, in the Aspect kind of diversified fund, we're trading over 180 different markets. We're trading 240 contracts. A lot of these replicator funds are effectively using principal component type analysis, but actually narrowing down their replication, trying to replicate that performance with a much, much, much kind of smaller kind of subset of markets. So, if the market returns are actually kind of generated outside that market set, again, there's a risk they're going to underperform. I think the other element is that I think if you actually look at the majority of competitors today, in their main strategies, they'll be running a kind of combination of trend following models with what we internally kind of call modulating strategies. So we have an 80% allocation to our trend following models, a 20% allocation to what we term, as I said, modulating kind of factors, which are other persistent drivers of market behavior, such as carry, such as relative carry, such as cross-sectional momentum, such as sentiment, value, relative kind of value. Again, I'm not convinced that these kind of replicators are well placed to be able to replicate the performance from those modulating, those non-directional RV, highly kind of diverse kind of strategies. So those be the 3 key risks I'd point to.
Yeah, no, I think that those are all fair. I'll tell you one thing, and that is, because I agree with you that one of the things that's very interesting, that's this thing about trading very few set of markets versus a typical CTA trading a lot. And you would think like a period right now where cocoa is such an interesting market for those of us who are fully diversified. But actually, I have to say, some of these replicators have kept up pretty well with the CTA indices. So it's an interesting discussion.
It is an interesting discussion, and as I said, to me, we will only know the answer to your kind of question as to whether they really are a threat in 5 years' time. It's going to play out over the long term. But in my view, at the moment, actually within the CTA sector, you've got an extensive number of very kind of strong competitors who've invested very heavily in research and development, continue to evolve their models over the long term. If I were an allocator actually kind of coming to the space, would I actually kind of back a collection of those kind of managers who've invested heavily in research and development, or in a replicator who's trying to replicate what those underlying managers are doing? I would just go for the former. I just think the risks are too great to actually kind of go down the other route.
Alan, where are we going to take our conversation now?
Well, just coming back to what we were talking about maybe a little bit earlier around the role of trend following in a portfolio. Anthony, you mentioned where you're seeing the investor interest, obviously from private wealth management, and those types of investors would be running multi-asset portfolios. And just curious, obviously we touched on how trend following can have that role as a diversifier, as a crisis alpha generator, but also as a return generator. So, I mean, are you seeing any changes from that perspective now in terms of investor behavior? And I'm thinking in terms of, are allocations now funded as much out of the equity side, whereas for a while we had an argument around fixed income replacements. So the role of trend following in a multi-asset, where it's been funded out of, and also, from a sizing perspective, any changes there, would you say?
I don't think we're seeing a shift of that type, Alan. I think that again, it's one of the big shifts we've seen over the course of the last 10 years. And this was very much consultant driven, I would say, quite broadly within the US pension fund sector, where consultants were recommending to their pension fund investors that they should carve out part of their portfolio as a crisis risk offset or CRO or risk mitigating strategies, RMS, component. And typically those CRO or RMS collections of programs would actually comprise would be a combination of trend following, global macro, typically systematic global macro, diversified risk premia, and in some instances, ultra long duration bonds. So that perception that actually during a significant market crisis, with the exception of 2022, fixed income markets actually can provide valuable source of diversification. In answer to your question, I think that the aim was very much to actually provide a combination of first responder, second responder performance in the event of a market crisis, but also material positive long-term drift. So the material positive long-term drift, that would obviously it was expected to actually come from systematic global macro and diversified risk premia. I think the shift we're actually going to see now, as we see a return now to CTAs actually having far more positive drift than was seen during that period of 2009 through 2018. And I think as investor perception shifts, that CTAs don't just provide that crisis alpha, actually they can provide significant long-term drift. I think what we're going to see, Alan, is a redistribution of that asset allocation within those underlying portfolios. Because if you structure your portfolio on the basis that CTAs have pretty much no long-term positive drift, but are just there for crisis alpha, you're going to structure your portfolio one way. If you actually look at it on the basis of, well, hold on a second, actually they have significant positive long-term drift, significant positive sharp, and they provide crisis alpha, you're going to build your CRO or RMS portfolio in a different way.
Absolutely.
So that's where I think the allocation will come from.
Okay. Just curious, Neil's touched briefly on the the multi-strats to platforms. Where do you see those in terms of this whole debate around, constructing portfolios, both from the perspective of generating returns and providing downside protection and diversification? Do you think CTAs are now better placed to be seen as, competitors in that space, or are they seen as a very different allocation, would you say?
I think it's seen as a very different allocation because, a number of those multi-strategy firms have been able to generate, very, very, very strong, high sharp ratios, over an extended period. So I think they, are very much actually there to provide that long-term positive performance, irrespective of, bond and stock market performance. They perform a particular role in investors' portfolios. I think what is interesting, though, is, and again, obviously there's been a headlong rush into those strategies over the course of the last few years, and the performance has absolutely justified that. But I think we're beginning to see some degree of caution there on the basis of, of course, the massive level of pass-through fees. So increasingly investors are beginning to question that. But also because the imposition of longer-term lockups, we're seeing lockups of 3, 4, 5 years in some of these multi-strat programs. So suddenly, in terms of asset allocation, they have to be bucketed with those illiquid assets I was talking about earlier. And back to what I was saying, so I wouldn't bucket them in the same way as, at all in the same way that you'd bucket, infrastructure, real estate, private equity, private credit. But in terms of the liquidity profile, in terms of asset allocation, as I said, I think a number of investors we're talking to are reaching the limits that they're able to hold in illiquid assets. And those pod shop, multi-strategy firms, which were liquid, providing a reasonable degree of liquidity 5 years ago, are now far less liquid than they were then. That I think actually creates liquidity concerns for the underlying investors.
Absolutely. With just one final one in terms of the role of trend following in a multi-asset portfolio, and also maybe how it links to what we were talking about around customization, and particularly in the environment we're in now, where we're in kind of a risk-seeking environment, and trend following portfolios would tend to be risk on, long equities, and in this type of environment, investors sometimes worry about having that equity exposure within their trend following exposure as well as being long equities. And in response to that, with some managers, we've seen moves to cap the equity beta or develop specific programs that do that. Do you think that's a sensible thing to do, or is it for particular clients, or how do you think about that when you're having conversations with investors?
Yeah, I think it is interesting actually, because so far this year that a number of investors will be looking on the basis of stock markets actually performed actually very very strongly so far this year. CTAs are performed strongly so far this year, therefore drawing the natural conclusion that the majority of the performance has actually come from stock indices. Actually, I think what's particularly striking in terms of CTA performance actually so far this year is the drivers of performance have actually been kind of quite broadly spread. And that's my point about you remove the distorting factor of central bank intervention, it suddenly can freeze up markets to operate far more normally, and that's created a wealth of opportunities on a broad front. So the divergence, I mentioned earlier how that degree of central bank coordination has now completely gone out of the window. We've actually got uncoordinated central bank responses at the moment. That's driving some very interesting returns in the currency markets, particularly in the yen, in particular, say, the euro against the yen, very strong trends there so far this year. You look at some idiosyncratic moves in the agricultural sector. So obviously, strong moves in the cocoa market actually so far this year. Worth actually highlighting incidentally that actually since beginning of January so far this year, in fact, what we've been doing is reduced our position very significantly in the cocoa markets. So we haven't been building a position there at all, quite the reverse. We've been selling into that strength. But also in the agricultural sector, some very strong trends in the corn market, in the wheat market as well. So broad spread, a series of drivers in the ags markets. And yes, that mood of optimism that we've hit peak inflation in the majority of kind of global economies. Yes, of course, yes, that's driving very kind of strong stock index returns. We've been able to kind of capture those as well. So your point, and it's well taken, if the vast majority of our returns so far this year were in stock indices, then yes, I can actually understand a bigger degree of concern that there was that concentration of risk, but it's not. The returns have been far, far, far more broadly driven. Specifically answering your kind of question, Alan, in terms of stock market risk. So yes, we actually do, cap the, aggregate level of stock market beta in the portfolio. Obviously, that stock market beta actually can come from stock indices, but it can also come elsewhere. It can come from the bond sector, in certain environments. So I do think there's a logic behind actually doing that, where you actually cap that level of beta. Again, I think it's important kind of consideration because of course, if you cap it too severely, you can end up in a kind of situation where you're dramatically underperforming the kind of competition, because actually, of course, it is one of the advantages of a trend following approach that it is agnostic about market direction. It's able to generate returns both on the positive side and on the negative side. So I think capping that beta, capping that risk, actually is a sensible response. But where you cap it, I think that's a very important consideration.
Yeah, maybe something that kind of points in the direction of what Anthony was talking about. Something that came out, I think maybe yesterday, a report from With Intelligence, I think it's called, where there was an analysis of hedge fund flows. And they actually write in the report that CTA managed futures had the lightest outflow among all primary hedge fund strategies in 2023. So despite actually not having a fantastic year, it was kind of a quiet, slightly negative year for some managers. But so that all sounds fine. But I wanted to, and I don't know if you want to talk about it, Anthony, but to me, one thing that really hasn't changed too much, and that's this thing about, when CTAs experience bad performance, we see investors leave. If we have flat performance for a period of time, we see investors leave. And then if we have really strong performance, like in 2022, we actually also see investors leave. So I'm I don't know. I mean, are investors becoming a little bit too difficult?
So wonderful observation. You on that basis.
I don't know.
Yes,
I mean, is there anything we can do?
How the sector actually still exists, don't you? I mean, no, I mean, I think you're right. I think we all know. A lot of people actually listening to this podcast who know the CTA sector well. It is a very difficult strategy to own. It's not a particularly kind of high Sharpe ratio kind of strategy over the long term. The returns are bursty, the returns are unpredictable, and they're very difficult to time. And unfortunately, some investors do try to time the returns and can typically top and tail the returns. How do we actually counter that? We have tried to actually counter that through working closely in partnership with our investors, providing that level of transparency, making absolutely sure that whether our performance is good, bad, or indifferent, that we're there very much proactively informing investors about the drivers of returns. So to try to make sure that when we actually do see those drawdowns are inevitable, and they're explainable, we're transparent, and they are expected. To draw a good example there, give you a specific example, Niels. I mean, if you look back at the SVB crisis back, in March, almost exactly a year ago, that was clearly a very, 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 sharp shock to the sector, obviously to markets in general. The majority of CTAs obviously were short, particularly of fixed income markets, actually going into March, going into that SVB crisis. When that crisis hit, our investor relations team, our risk management team, our research team were working over the weekend to understand exactly what were the drivers of the performance. Where did we actually have lost money? What were our risk management systems actually working effectively? How did our range of different filters, trend following filters, how did they actually respond? And that meant then on the Monday morning, we were able to proactively talk to our investors and explain exactly what had happened to during the course of the crisis, explain the performance, explain exactly what the drivers of the performance actually were. So as a result of that, and a pattern of doing that over multiple years, in an environment such as that, and that was a very short, sharp, sudden drawdown, we didn't see any investor outflows at all. I think if we hadn't been so transparent as again, I don't just mean during that environment, but over multiple years, investors suddenly woke up and saw that sharp correction in their portfolio, it could have led to redemptions. As I said, we didn't see any redemptions at all.
Yeah, no, that's a great example. I think the last sort of 10, 15 minutes, I think we're going to try and look maybe a little bit into the future, not specifically, but one of the things that's buzzwords in our industry right now, it's AI and alternative data. We've seen a number of our peers and friends in the industry adopt either one of them or both of them. What is your view on this, and how do you make use of it if you do?
Yep, I mean, I think in terms of alternative data, that's been an area of strong investment for us over the course of the last 7 or 8 years. So particularly in our systematic global macro program, but also elsewhere. So when we can talk about alternative data, we're talking about non-pure price-based data. So looking at data, for instance, such as nowcasting data, so more instantaneous measures of certain key economic indicators, or could be actually looking at flow data. Those become two prime examples. So yes, we can actually see that those sources of data can actually provide valuable, additional diversifying sources of return. I think it's important, and I'll come on to AI in a moment. But in terms of some of the central tenets of our research process, one of the crucial central tenets is that everything we do is hypothesis driven. So we don't undertake research on the basis of just trust the data. We looked on the basis that any effect we're actually trying to identify in the first place has to be backed up by a hypothesis about market behavior. That's a very different approach from a data-driven approach, which is much more, if you have enough data and strong enough statistics, then actually just can trust the results. We don't work on that basis. As I said, it's all about starting with a clear hypothesis about market behavior. I think the second key tenet, which actually kind of comes back to my point about how we work in partnership with our investors, is making sure that positions we take in the market are intuitive and they're explainable. To me, that's one of the great attractions of the trend following approach, that you pick any individual market. We were talking earlier about what's happening in the stock markets, what's happening in the agricultural markets, what's happening in the currency markets. All the positions we're actually taking are as I said, entirely intuitive. And then the third key element is that style consistency, avoiding style drift. So, we can talk, maybe we'll talk a little bit later about how our models have evolved over the course of the last 25 years. But it's interesting in terms of the investment philosophy we had back 25 years ago. Was the aim of capturing medium-term trends over 2 to 3 months or longer across a diversified set of markets. That's what we do today. So we've been entirely consistent in our approach. The reason for mentioning those 3 tenets is that, to me, that's so important when we're actually looking at new, interesting areas of research, such as alternative data. So, as I said, we do use alternative data, but we have to actually make sure that, again, that it's the work we're doing, the research we're doing is hypothesis-driven, that we're avoiding style drift, and positions are intuitive. In terms of AI, we as a derivative of AI, machine learning, we've had a significant investment in machine learning over the course of the last 7 years, and actually run not in our trend following program, but in our multi-strat program, we run a sleeve of 24 machine learning models. But those machine learning models, they are constrained. So again, all hypothesis driven, and the positions we're taking again entirely intuitive and explicable. So in terms of turning attention to AI, we see huge advantages in the application of AI. I think particularly with relation to increasing productivity in research and increasing productivity in terms of coding. But we're moving cautiously, on the basis of, as I said, we need to actually make sure that any work we do using AI, that the work is hypothesis driven. We're not just asking AI for a solution. And I think that the fourth consideration, particularly with AI, is protection of IP. That again, some of the approaches, some of the techniques one can use with AI would require you to actually open up your systems, open up your models to the wider market. We're obviously, although we can provide a high degree of transparency to our investors, we're highly protective of our IP. So in terms of both areas, just to summarize, in terms of both areas, yes, absolutely, we're very excited and have significant investments in both areas, but we move, I would say, carefully, cautiously, and make sure, as I said, that our approach is consistent with those central tenets.
Yeah, no, makes perfect sense. Alan, do you want to go through your last round of questions and topics before we slowly start to
Sure.
down?
Well, we Anthony touched briefly there on the the evolution of the models over 25 years, and obviously a big development has been development of I imagine the modulating strategies and machine learning strategies, but maybe just from a pure trend following perspective, Anthony, have those core models evolved dramatically from the the core ideas that Marty would have developed back in the AHL days, and give us a sense on the areas and how they've evolved?
Yeah. No, I think it's really interesting looking back at it, Alan, and as I mentioned earlier, right at the early days of Aspect back in 1997, 1998, our aim was to build a medium-term trend following program, capturing trends over a period of 2 to 3 months or longer, over a broad set of diversifying markets. And there's an element at the very highest level, that's exactly what we're trying to do today. But to me, what's interesting is the level of sophistication of the underlying models is just, it's again night and day by comparison with where we were back in 1997, 1998. If I can actually just pick on a couple of individual factors, First and most obvious one is just the number of markets we trade. So actually, back when we started trading December 1998, the portfolio consisted of 64 markets. Today, as I mentioned earlier, we're trading 180 markets, and obviously trading multiple kind of contracts in those individual markets. We're now trading over 240 contracts. So the portfolio is kind of far more kind of diversified. I think in terms of data, obviously the data we were actually kind of using back in the early days, we were just purely simply using daily kind of price data. The level of kind of granularity of data we're actually using today is again significantly finer in terms of kind of granularity of the data we were using back to kind of 25 years ago. I think in terms of the models themselves, you could actually break it down into two particular elements. One is just kind of trend identification. So the filters we actually use to kind of try to identify in each individual market whether we're in an uptrend or downtrend. Those filters are significantly more advanced than they were kind of 25 years ago. And then how do you actually then kind of translate that, if you like, that trend strength into a position in the markets? We talk about the application of a position function. That's the way we actually can translate a trend signal into a position in the market. Again, significant amount of work, significant amount of research has actually gone into refining those position functions over the years. I think most recently, Alan, if I'm looking over the course of the last kind of 5 years, a significant kind of focus of research has been put into actually kind of trying to improve our responsiveness at turning points in markets. So prime example of the turning point I'm referring to would be the SVB crisis in March 2023. But actually, retaining the overall level of responsiveness across the entire portfolio. So obviously, one way you can improve your responsiveness is just speed up the models. We looked at that, and I think actually during that tough period of performance between 2009 and 2018. A number of investors, a number of commentators, a number of our competitors actually kind of took the view that market behavior has actually changed and markets have become faster to respond to market news, and therefore the right thing to do was speed up. We looked at that in extensive detail and we could not reach that same conclusion. That those most dangerous words in finance, this time is different. We could not actually see any evidence that market behavior had changed. So we retained our aggregate level of responsiveness, but did a lot of work trying to actually kind of identify ways of, as I said, improving our responsiveness at those turning points. And I think, as I said, it's only a sample of one so far, but the results we actually saw around the time of that SVB crisis was strong out of sample evidence that the research has been very much on the right track there.
We've talked a lot about your path, your journey, and how Aspect has evolved so far over the last 25 years. So I'm kind of curious, maybe looking a little bit into the future. I mean, I work for a firm where we have done the transition from founder to a new owner. But a lot of our friends in the industry, including yourself, it's still the founders that runs the firms. But at some point, maybe it's far in the future, I don't know, Anthony, for you, at some point, maybe there's going to be a next generation of leadership, ownership, I don't know. So I'm just curious whether you think about sort of Aspect 2.0 or whatever point we're at, what it might look like. And also just when you, and maybe we've talked about this already, but sort of looking into 2024, what excites you? What are the threats you see maybe for our industry?
Yeah, it's interesting. Martin and I were discussing this the other day, and Martin's immediate response was, "Well, look at AHL. There's no A, there's no H, there's no L, and the business seems to be doing pretty well without them." So I think there are strong lessons from from there. Our philosophy right from day one, Niels, was to actually build a business that would outlast the founders. How did we actually kind of go about doing that? First thing was actually make sure we actually built a very kind of strong team, around us, but also build a much more collegiate approach to decision making, devolved decision making, as opposed to just having decision making kind of concentrated at the top. So it's very much like a focus on Martin and I over that kind of 25 years is to try to delegate as much responsibility as we kind of possibly can to our senior managers across the business, and avoid that top-down approach. If you actually could look at the caliber and experience of the researchers that we have at the moment, and of course it's not all about research. If I could look at the trading team, I look at our middle and back office team, I look at our finance team, I look at our business development team. There's real kind of strength and depth there. I see this because, as a business, by example, everybody who's been in the company for kind of 5 years automatically gets a 4-week paid sabbatical. It's just very much a congratulations, go and take time off, go and recharge your batteries, come back. And I get an email every time somebody takes a sabbatical. Now, the number of people now in the company who are on their third, an increasing number of people taking their fourth sabbaticals, is extraordinary. And I think that just kind of demonstrates, hopefully it demonstrates something about the culture of the company, but it also just kind of demonstrates the strength and depth and level of experience we've actually got across the entire company. Niels, your question is well taken. Martin, I know very alive to it. But as I said, I think it's very much an essential feature of the business is build a company where there is going to be that consistency of approach, no change in terms of how investors' money will be run, irrespective of who's actually driving it.
Yeah, no, absolutely. And finally, Anthony, anything that we haven't talked about, maybe that we missed bringing up, but also maybe something you just want to sort of round things up with, maybe also a view into 2024 of things that we haven't talked about, perhaps.
Yeah, I think in some respects, in some areas of the markets, to me, I mentioned earlier that the private wealth managers, that's where we're seeing strongest demand at the moment. There's no doubt that at the moment, although we're seeing strong pockets of demand, very strong pockets of demand, for trend following from certain areas, there are still other areas where the view is, why do we need the kind of diversification? Look, haven't you looked at the stock market over the course of the last kind of couple of years? Why would I look to kind of diversify? Or as I said, there's this kind of focus on private markets. So to me, there is a degree of echo that I'm hearing, back from when we actually started the company, back in 1997. And actually, I think there are a lot of similarities there. So you remember back in 1994, the Fed, had been behind the curve in terms of interest rates. Actually, suddenly put up interest rates actually very dramatically. Bond market kind of crisis in 1994, but then they actually managed to execute that soft landing. We saw this benign period, this kind of Goldilocks style economy, during the period of 1995 through 1999, not too hot, not too cold, and a remarkable bull market in stocks, which abruptly kind of came to the end in 2000. Now, worth bearing in mind that although during that time, when we were setting up Aspect, it was difficult to find investors who were looking to diversify their portfolios. As I said, the focus was very much on internet-related stocks, so very much on the technology area. CTAs actually provided incredibly strong returns over that period, 1995 through 1999. So to me, the sense at the moment said we're not economists, but there just seems to be a strong sense that we're moving into a soft landing type environment. Are we at bubble levels yet in certain technology stocks? I'm just not qualified to opine on that. But I think for investors, actually, there are interesting similarities, interesting lessons to be learned from that period. That during that soft landing environments, managed futures was able to provide very strong back-to-back positive years for an extended period. But when the crisis hit, in 2000, and investors really need that diversification, then managed futures was able to provide that crisis alpha. And so to me, go back on just referring back to Alan's kind of comments, this repositioning of the whole kind of sector, that to me is so important at the moment, because I think that it's a very remarkable environment in terms of the range of opportunities for managed futures, at the moment in this potentially this soft landing environment. But maybe there's a risk there of a crisis looming at some point. So investors shouldn't actually also ignore that crisis alpha, those crisis alpha kind of characteristics of the managed futures sector.
Yeah, well said, Anthony. Thank you. That was a great way of wrapping up our conversation. And it's been fascinating. I really appreciate it and appreciate you for coming on the podcast and sharing your thoughts and insights. And of course, we hope we can do this sometime again in the future. And to all of you listening in today, I hope that you were able to take something from today's conversation onto your own investment journey. And if you did, please share these episodes with your friends and colleagues. From Alan and me, thanks for listening. We look forward to being back with you on the next episode of Top Traders Unplugged as we continue our journey into the CTA industry. And in the meantime, go check out the show notes for this episode and all the other resources you can find on our website. And not least, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.